Hello and welcome to the inaugural FirstCapital webinar on how to prepare for a trade sale. I'm Natasha McKenzie, Head of Marketing for FirstCapital. This is the first in a series of presentations that we shall share over the coming months. Please do visit our website, firstcapital.co.uk, to sign up for further webinars, our newsletter, news and views. This webinar has been created to be applicable for all scale of business. We shall take you through our smart deal-making framework with relevant case studies. If you have any questions, please use the questions tab and we shall endeavour to answer as many questions as possible at the end of this presentation. And now I shall introduce you to our presenter, Hazel More. Hazel More is FirstCapital's co-founder and chairman. With over 25 years of experience advising on corporate finance matters, she's worked with technology companies and investors great and small. From acquisitions to exits, IPOs to MBOs, Hazel's expertise means she's served on advisory panels and spoken at conferences across Europe and the United States. I shall hand you over to Hazel now to give you her advice on how to prepare for a trade sale.
Thanks, Natasha. And ladies and gentlemen, thanks for joining us. In terms of timing, this webinar is going to last 30 minutes. And as Natasha has said, please do feel free to send in questions along the way, and I'll do my best to answer them at the end. So as Natasha said, this webinar is called Preparing for a Trade Sale. And what I'm going to do is I'm going to take you through the key issues that we think are important in preparing for and then in executing a trade sale, and what you might expect along the way. I'll do this using the smart deal-making framework that FirstCapital has codified and use this framework to describe each of the steps. Then we'll look at what to do next and take some Q&A at the end. But first, let me give you just a very brief introduction to FirstCapital. We are an international investment bank specializing in advising high-growth technology businesses in Europe on M&A, private equity, and fundraising. Our sweet spot is deals worth between $50 and $500 million, focused on the software, internet and digital media, and tech-enabled services sectors. Our clients know us for delivering win-win deals where we maximize the strategic value and deliver premium results. And on average, just to give you some metrics on that, over the last 16 years we've delivered a 50% uplift in valuation for our clients using this SMART framework to drive the process. So SMART represents each of the stages in a trade sale process. And what I mean by that is strategic insight, marketing, access, rigorous negotiation, and transaction close. And I'll take you through each of these steps in the next 20 minutes. But first, let's look at this holistically. I've lost count of the number of times that people say to me that they're not going to plan an exit. They say, we're just going to build something great, and then Google or Microsoft or Facebook or whomever will call a huge price. And yes, this does occasionally happen, but for the vast majority of people, life isn't usually like that. An exit takes planning, often over several years, and I always like to think of it as a process and not as an event. So thinking through that, in the couple of years ahead of any potential exit, there are some key things to think about, most important of which is, do you know who your buyers are? And more importantly, do they know who you are? Most buyers maintain a list of companies that they're interested in buying and why. And for European businesses who want to sell to a US tech buyer, building awareness, building strategic relationships into the key groups can take time. So you need to invest in this activity. Then as you get closer to the time, you need to get yourself ready to do a deal. This means, for example, putting succession planning in place if you want to step back post-sale, getting robust key performance indicators and management information systems, and focusing on delivering to plan and hitting your numbers. If you can demonstrate a track record of successful delivery, you will greatly increase your credibility with potential buyers, and that will give them more confidence in paying a better price. Also, over this period, talk to advisors and decide who you want to work with. And then finally, when you decide to push the button and start a process to talk to buyers, to close a transaction, you need to be ready to close that deal. And here, this is all about making sure that all of your stakeholders are agreed on what success looks like and what you're aiming for, that you have the right resources in place to support what can be a time-consuming process without impacting the business negatively. So what we'll do over the next few slides is look at how this breaks down into the steps in the SMART deal-making framework. S is the first step, and this stands for strategic insight, and this is the piece that you need to start working on ahead of time. This is all about how you talk about yourselves in your marketplace and how you align yourself with the strategic drivers that are important for your buyer group. There's a huge difference between a mundane, accurate but run-of-the-mill positioning and an insightful strategic vision for how you enable and create value for others, and that can mean many millions more in value on a transaction. Starts with really understanding your market, not only your customers and their needs and problems and how the market's growing and evolving, but an honest understanding of who your competitors really are, where they're growing, their limitations, their threats. It also means thinking outside the box. Who else is out there who might be operating in adjacent or complementary markets? How might you fit with their objectives? This means some serious navel gazing and thinking about what is it that you do that's really unique and different, and why is this important to anyone? So here I have two key recommendations. Firstly, talk to people. Sounds obvious, but many people don't. Unless you talk to others in your field or your potential buyer groups, you don't really know what's important to them. You don't really know how what you do fits with their going. And you don't really know who's a buyer. Secondly, on at least an annual basis, take a day out. Go off-site with your board or with trusted advisors to examine where you're going and to set clear strategic objectives and goals. So let's look next at how a case study of how good strategic insight can deliver value. Salmon was a client of ours. They designed, built and managed e-commerce systems for large retailers based on IBM technology, and they thought of themselves as a consultant and a systems integrator. They'd had some inbound interest and engaged us to manage a process. In that first period, in discussions with them about their clients and about what they did for them, we realized that their key value proposition was in the digital design front-end piece, helping their clients to understand what they should be doing online, and then in implementing that delivery capability that enabled their customers to go live with critical e-commerce systems and manage them. This was something that we knew from discussions with buyers was a key pain point for the marketing communications agencies. They were investing heavily in their digital capability, but they lacked an end-to-end solution, and so were losing key business as a result. So we ran a process to engage this new category of high-value buyers with a new set of messaging tailored to their requirements, and generated a very competitive process that resulted in a significant valuation premium for the client versus the original proposition. So the strategic positioning phase, it can take a month, it can be something that you work on over a couple of years. But until you have clarity on this, you're not really ready to move to the next phase. And the next phase in the SMART framework is M. MM4 Marketing. So you've got your strategic positioning, you think you're ready to start to talk to buyers, but first you need to reduce your key messages to a set of clear and compelling marketing documentation. And you'll use this throughout the exit process to move your potential buyers through their decision making. As the saying goes, you do not get a second chance to make a first impression. So your documents have to really hit the mark. It's worth remembering also that the key purpose of each document is only to give enough information to attract the buyer and to move them forward to the next stage. And no more than that, really. So you start with a short, high-level teaser, non-confidential, that you can pitch briefly and use to attract process. You just want them at this stage to say, yes, I want more information. Then you've got them interested, you've got them on the hook. Then you can share a little bit more information. The key documents are shown on the screen, but two things are worth bearing in mind. When do you get the buyer to sign an NDA? And when do you say, enough, no more information until you make an offer and show us you're serious? I think the answers to those two questions are, from an NDA perspective, generally post-teaser and before you share anything else, although occasionally you may have a high-level introductory management meeting without. And how much is enough? Well, really, if you've thought through your information memorandum properly, a buyer should have enough information on the basis of an IM and a meeting to be able to give you an initial indication. So don't get sucked into providing more and more information without getting commitment on their side. And I'll show you how to do that later. The other documents, the model, the vendor due diligence, if you use it, and the data room are all for post that initial offer. But it is worth preparing them up front to avoid delays, because once you get into the meat of the process, you're going to be very busy, and you want to be able to maintain momentum and competitive tension throughout. I have included here vendor due diligence as one of the core documents for a process. Actually, in a trade sale, it's rarely used, but if you're thinking instead about selling to a financial buyer, to private equity, it's a really important document that will significantly speed up the process. So it is worth investing in. As I've said, it's worth putting in the time before you start talking to people to make sure that you're as prepared as possible. It is time-consuming and resource-intensive to go through a trade sale, so being prepared up front is an investment worth making. Bear in mind that on the other side, the buyers will deploy armies of people to assess and do due diligence on you. We'll talk about some of the people who will be involved later on. But our clients are often surprised by how much support and resource they have relied on from us to get a deal done successfully. And I've included here a couple of quotes to illustrate. Now, you've done the prep. You're ready to start a roadshow process. You want to talk to people. A is for access. Who do you talk to at your target buyer? Do you talk to the business unit? Do you talk to the corporate development, also known as M&A people? There are so many people with so many confusing job titles. How do you know which is the right person to talk to get the maximum impact as quickly as possible? The business unit always sponsors the deal, always owns the business case. If you're not on their strategic roadmap and in their key priority areas, then the deal's unlikely to go forward. Hopefully you will have been talking to these people over the previous couple of years as part of the strategic development referred to earlier. So they'll be aware of you, they'll have a good sense of the commercial opportunity, and you'll have a sense of where you sit on their roadmap. Corporate development owns the deal process. These guys act as the key gatekeepers. They do horizon scanning, they screen for known areas of interest, they work with the executives to determine priorities. And they are the ones who are responsible for executing the deals. Very often we talk to people who have had an inbound approach from the business unit, and the business unit is really keen, and our guys have spent a lot of time, they've shared a lot of information, and they're frustrated because the deal hasn't materialized. I think the thing here is, if corporate development is not involved, then there is no deal. Maybe of interest to the business unit, but perhaps it's not a corporate priority. So don't waste too much time until you see the deal guys on the horizon. Some corporates are opportunistic and will respond to a cold approach, but most often the buyer has a list of companies they're interested in. And from the discussions with the business unit that people have been having on the ground and the targets, they're already known to them, they're already on the list. So the key takeaway is invest the time to make sure they know who you are. If they don't know you, it can take a lot of time to build the internal awareness, and that just means it's hard to get them to respond quickly in a process. FirstCapital has developed relationships with the buyer community in our target markets over the last 16 years, and we work hard to maintain fresh and up-to-date contacts, both within the business units as well as in the corporate development department. We're in regular contact. We make sure we know what's important and what's not, and where the areas for potential acquisition interest are at any one time. And things can change quarterly, so they do move fast. Depending on the process we're running and how well known our client is to the buyers, we may engage in soft marketing initially, and that's talking to the business unit to get a company on the radar screen and to build the case and build the internal awareness. But if we're running a very competitive, very fast-moving process where we need the execution team to be fully engaged, we'll go first to corporate development because they will drive their internal teams to a deal timetable. If it's of interest, they'll bring the business unit people in quickly to do the initial evaluation and to get their buy-in. And what we're really trying to do is, throughout the course of a formal roadshow, is to move the buyers through to a point where they're ready to submit a written offer. It will be non-binding at this stage, but that starts the next phase of the SMART process, which is called rigorous negotiation. So you've got your buyers lined up, they're ready to make offers. How do you optimize these offers and drive the best results for the client? Always, always a good idea to have competitive tension. An auction can be two people, or it can be more, but human nature dictates that if there is only one buyer, they are going to make the lowest possible offer they think they can get away with. We've done deals where there's been an inbound and the client has got us in to close it, and we've done deals where there's been an inbound and the client has asked us to generate some competitive tension. Without exception, the latter always delivers a better result, either in terms of a better price, a shorter time to close, or often a better partner than the first one. Even in the early stages of the negotiation process, it's always a good idea to be clear about what you want the buyer to put on the table to avoid misunderstanding or to enable a like-for-like comparison of two or more bids. We'll send out a process letter specifying what we want to see in an offer. This would typically include obvious things like price and how they'll pay. Is it cash? Is it stock? What are they going to do in terms of an earnout? But we also ask for other details that have implications for the timing of a close, for the risk of getting to a close, and for any difficult things that are going to come up in negotiating the legal agreements. Some of those might include things like, how will they finance the acquisition? Is that financing already available, or does it need to be secured? What further due diligence do they need to do? Who needs to approve the deal, and how far down that process are we? Anticipated transaction closing date. Sometimes you'll have a number of potential bidders, too many, and you actually want to reduce the field so that you can concentrate on the best options. And in this case, you might have a first round, disqualify some of the bidders, and then ask a smaller number of potential buyers to bid again. Possibly you might give them some more information so that they can confirm their price. And this gives you more scope to negotiate harder and to reduce risk to come up with your preferred party. Obviously, when you're looking at potential deals, it's worth saying something about how you get paid and what are you being paid in. Number one point, cash on close is king. Cash you can take to the bank. If the buyer's offering their own stock, the question is, what's that really worth? You're likely swapping a large stake in something that you can control, your own business, to a smaller stake in something that you cannot. Are you able to influence what that's worth? If it's a listed entity, in which case there's a ready market if you want to sell, or is it private, in which case, what's the time frame for selling? What's the risk associated with that? What will it be worth when you sell it? And on earn-outs, how much of the value being offered is based on a future payment associated with delivery of some milestone. Sometimes clients accept an earn-out only to find that once they're in the combined entity, they no longer have access to the resources that they need to deliver, or that the market has changed but they're locked into a structure that no longer makes sense. So you need to look at all of these things to figure out which is the best overall deal, and it can be worth accepting a deal that on paper has a lower value, but where more of that value is in cash or is readily realizable. And so when you're thinking about a deal, you need to look at the structure of the deal, you need to look at the overall terms, and you'd say, actually, what's the best outcome for me and my stakeholders? And that's something that we can help you work your way through. So finally, we've got an agreed deal, we've got a preferred bidder, we're at the last stage of the transaction, the close. Number one priority for the transaction close phase is to close the deal on the terms agreed in the shortest possible time. So when you've negotiated your letter of intent with your preferred buyer, you've likely had to give them an exclusivity period to close. You should keep this as short as possible so that in the event that there are any issues, you still have the threat of going back to the other bidders and therefore of the buyer losing the deal, so that keeps a bit of tension for them. Also, hopefully you'll have negotiated as many of the key terms as possible before you move into exclusivity, so that putting it all into the definitive legal agreements doesn't give your buyer too much wiggle room and allows you to remain strong in your negotiations. Here it's important to have a great lawyer that is experienced in deals of this type and who keeps focused on the important issues and bats away the excess. The other thing is, as we said early on, you've already prepared your data room, and somebody, typically your finance director, will need to be fully engaged in making sure all the I's are dotted and the T's are crossed. Now is not the time to disclose that a major customer has given notice or that you're about to be sued by a disgruntled former employee. All of these issues should have been addressed with your advisors up front in the preparation phase and a strategy agreed to deal with it. Lastly, a word on due diligence and approvals. I mentioned it earlier, but if you are selling to a large buyer, they will deploy armies of people in the process, and it is easy to be overwhelmed. There will be business unit teams, functional teams, for example, finance, tax, integration teams, all asking questions, working out business cases, post-acquisition plans, etc. There'll be the deal teams working on the transaction, and there'll be the executives who need to approve the deal. If the deal needs to go to the main board for approval, be sure that you know how much visibility the executive has had of the deal to date and what the proposed date that this is scheduled for board consideration is, and plan that into your timetable. If the deal slips, you'll have at best a month's delay, quite possibly longer, and all delays introduce risk. The final hours and days of a deal can be really very stressful and very time-consuming. But if you have good advisors around you, they can help you focus on the important issues and diffuse any potential sticky situations with your buyer. And after all, you may have to continue to work closely with the buyer post-deal, so you do want to keep a good professional relationship and not allow it to get personal. And then The deal is done. Champagne corks are popping, cash is in the bank. Happy days. So let's just look at a summary slide of what this looks like. This slide is a summary at a very high level of how a successful smart sale process works and what we do to support you and help you achieve the best possible deal. SMART is about strong preparation, which really boils down to understanding who you're most valuable to and backing that up with a compelling case supported by high quality materials. Then it's about getting in front of the right motivated buyers and performing at your best in meetings with them, working the process to bring them to the table at the right time so that you can run an auction to get the best outcome. And finally, it's about taking the winning bidder through the close process and making sure that the deal closes on the agreed terms in the shortest possible time. In terms of timing, trade sale typically takes about 6 months to close, but when you consider the time taken in the run-up and getting yourself ready, it's really something that you should be thinking about and preparing for a minimum of 1 to 2 years ahead of time. So what should you do next? If you're a tech company thinking about a potential exit at some stage, it's never too early to have a conversation. Get in touch. Let's have a chat. Let's explore the best options for you. We have a few minutes left, so I'd be very happy to take questions that may have come up during the course of this webinar.
Thank you, Hazel. That was really interesting. We've had a number of questions, and we'll take 3 of the most popular questions this afternoon. So, number 1, Hazel, perhaps could you just tell us when is a good time for a company to contact you regarding the sale of their business?
I think the answer to that, Natasha, is it's really never too early. Some of the decisions that you might be thinking about taking as a board and as a management team can have implications for how attractive you are to a buyer group in the future. And you may wish to think through how your product roadmap fits with what's going on in the market or fits with the priorities and how the priorities of the key buyers are changing. So, come and talk to us. Come and talk to us. There doesn't have to be a commitment on either side, but just let's understand the options. Let's talk through your plans, and let's just we can give you some hints and some pointers, and we'll keep the conversation going. And as we talk to buyers and find out information and things that are helpful and useful, we can reflect that back to you as well over time. So I think short answer is it's never too early. So we'd love to have a conversation.
Great, thank you, Hazel. Another question that's come up a few times from various different people: how long does the average sale normally take from start to finish?
Well, I think, as I've said, if you consider a process to be, we've decided to sell, we're going to start preparing documents, and we're going to, and if you take it from the time that you formally start working on a process to the time that the transaction actually closes, it's typically about 6 months. But as I said, I like to think of a process, an exit, as something that you work towards over a period of time. So if you consider all of that, pre-planning and execution, you should really add in another year or 2. But a formal process from start to finish, typically about 6 months. Again, it does depend. If you are known to your buyers, and perhaps if you're responding to an inbound approach, it can be a bit quicker than that. If you need to warm up the buyers and develop the business case, it can take longer. Maybe 9 months, 12 months, because you need to get that internal buy-in from the business units during the course of the process. So it is flexible, but at a minimum, you should plan for 6 months.
Okay, great. That gives us some concept. And third and final question, Hazel. Is it all about the EBITDA revenues, or do buyers look at other factors too?
Oh, I think that there are, particularly for tech companies, there's always a strategic angle. If you can find the right buyer group, there can be a big difference between getting a run-of-the-mill valuation based on your financial metrics and finding that strategic fit where there's really extra value for the buyer on the other side, and capturing some of that value in a transaction. I mean, for sure, Google didn't buy DeepMind for $500 million based on any financial metrics. They bought it because artificial intelligence was really important to them and to their roadmap, and they wanted access to those skills and that technology. So finding that strategic fit can add many, many millions in terms of the acquisition price. But good financial performance is always important. Buyers are largely focused on revenue growth, and then what they can do with your products and what revenue they can generate within their channels. So being able to show a good, strong customer market fit, good revenue projections, good revenue growth, that's also going to help build your case.
Thank you, Hazel. Well, that's just about all we've got time for today. I trust that the webinar's given you all some good food for thought. There's clearly a thoroughly thought through, smart framework in place there, and some great insight, Hazel. Please do get in touch with any further questions or visit our website, firstcapital.co.uk, to sign up for further webinars, our newsletter, news and views. Many thanks.